Welcome back to the Everything Property Podcast. We have joining us again, back on the pod, Mat Djolic from Higher Than Average Growth. A few weeks back, he took us through the Queensland markets, what was hot, what was cold, what was not. Now we're heading south to Victoria to see what are the hot markets, what are the warm markets. I think a lot of we were talking before this, Matt, a lot of the Perth investors are heading over to Victoria. There's some people that didn't like it because of the land tax, but there's been some announcements, and I think the smart investors have been getting into Victoria quite early. So it's going to be interesting to pick your brain and see what your thoughts, feelings, and emotions are about the Vic market. So look, welcome to the podcast.
Thanks again. Thanks for having me, man.
Yeah, been a long time. I see. I see that face everywhere. But look, let's jump straight into it. So for anyone that's maybe considering the Melbourne market, what we're going to do, if you haven't listened to it as well, flick back to the Queensland episode. But essentially, we're using Matt's software, Higher Than Average Growth. We're putting in a number of filters. We'll first look at that sub 550 market in Queensland because that market has moved so much. There wasn't too many options. We'll then go 550 to 800 and 800 above. So we're sort of covering every single area there of investors and budgets. But Matt, take us through 550. What are some of the other filters that we're applying to this data to get us down to this final list?
Yeah, so because we want warm spots, I mean, as per the last episode as well, I discussed, you need to have high confidence data. You need to have industries that are diversified and don't have exposure to bushfires and floodings, which is encapsulated in our RCS lower risk score that you can see there. Then to ensure that, warm spots will become hot spots, you need to find areas that contain affordable real estate because it's going to onset or kickstart the owner-occupier demand, which is why we set that affordability index at less than 35 years to own. Now, for this price point, I always say the sweet spot will be between 25 and 30, but we cast a wider net just to include more options just in case. And then we go into restricting the supply. So because you already have affordable real estate that can be purchased by the owner-occupier cohort, and you have a restricted supply, just even small increases in demand will actually lead to price growth, and it will sort of invite investors to the market. So that's what I've done. Can
I ask you a question? Do we filter anything around population here?
No. I mean, we have a population metric, but...
Yeah. Net immigration, state to state or from overseas, what are we...
Well, if there's an increase in population, it will be reflected in the days on market, wouldn't it?
Okay.
Because if there's more people buying homes, the days on market would drop and the stock market would drop.
Okay, so that's sort of the point before.
Yeah, so you want to go as close to the purchasing point as possible to understand and predict what's going to happen next. Now, population growth is separated by a couple of degrees of separation between price growth. Why do I say that? It's one thing to have an increasing population, but it's yet another thing to have the willingness to purchase property. You know what I mean? So now population is an important factor, don't get me wrong. But if the population is increasing and you need more homes, and the homes are not being built, that would mean that the stock market is coming down, wouldn't it? And then if there's more people bidding for the same home, that means that the days on market will be reducing. Would it be sitting at 50? Will be sitting at 25, Yep. Now, another thing about population as a side point, the larger populations don't inadvertently mean higher growth. So you have a lot of towns, and again, you can put, a risk measure against it if you're uncomfortable about it, but you have very small towns that have grown 150% in a decade. So it doesn't mean that because you have higher populations, you're inadvertently going to have more growth, because higher populations also mean more homes and more supply. So, there is a bit of a caveat around that be cautious about assuming that larger numbers inadvertently inform higher growth.
Great. Okay. I just thought I'd ask you. That's all, because
it would require a bit of a triangulation in a sense that if we have an increase, so we have a population metric, and I guess a great proxy. Remember how in the last pod we mentioned ratios, like building approval ratio. A great demand metric would be annual sales to dwelling ratio, for example. So the number of sales annually within a particular suburb compared to the number of dwellings. And the higher the percentage, that means that the more intense demand is long term, you know. And we do that in our comparisons. For example, we have, you know, number of sales, annual number of sales, we divided by, you know, by the dwellings, and you get sort of a ratio. So you get a bit of an intense representation of long-term demand. Now, population growth is a decent metric, and it's a metric that's actually going to be included within the next month and a half, I think. We currently have population size, but not population growth. It's going to come. But again, as I say, if the population is growing and there's more demand for real estate, then, you know, homes will be sitting advertised on realestate.com less days rather than more, you know.
Correct, but there may be a lag factor, right? That if your population has grown, you're growing short term, or say over a quarter, the lag time for you then to see the ramifications of that might be 1 or 2 years.
Yeah, but you also have a days on market trend that's 5 years.
Okay, I see. Yeah, I get you. So you're just closer to that point of sale.
I'm just closer to the point of purchase, you know, which is more, it just, you know, reflects more the ability and willingness for people to purchase property.
Great, cool.
So. And then, I mean, we restricted the supply. We made sure the supply is tight. One thing, again, to mention is very important. If you're looking for a warm spot, and a warm spot usually turns into a hot spot between 2 to 3 or 2 to 4 years into the future, you want to make sure that your building approvals are restricted. So there's no influx of new dwellings into the future, which is going to dampen your price growth and actually kick the can down the road and make the warm spot be a warm spot for much longer. And then the whole period's, again, addressing the livability factor, making sure that people retain property within a particular market for at least one cycle, between 7 to 10 years. And we have the right foundation for a warm spot. I don't consider demand at this stage simply because of warm spot, a perfect warm spot. We even have a flat or even slightly increasing demand trend.
Yep.
As long as the recent demand trend is dropping or the vacancy rate is dropping.
Perfect.
As well.
So look, we have high confidence in data. We're going anything sub 550, anything that is affordable to own, that the people in the particular suburb can buy it in 35 years or less. Stock on market,
long-term
is sloping. Inventory long-term is sloping. Building approvals are less than 1.5% of the total houses in that particular suburb, and people are holding on to that property longer or equal to 7 years, which tells me people are liking this suburb. There's no real long-term, short-term issues where people are selling and getting out in droves. Stability, long-term growth. Perfect. Correct. What do we have? What do you have in Victoria?
I haven't enabled the bedroom filter, so can't pronounce the first one. Werribee, is it?
Werribee, yeah.
Yeah. Golden Square, Kurrajong, Melton West, Brookfield, Newborough,
Sebastopol,
that's a hard one, and St Albans Park. Now, for me, it's a hard one.
Yeah.
So, and you have some great options there. Golden Square, Kurrajong, Melton West, and St Albans Park have been popping up regularly, and I think they're great opportunities for listeners. There is a concern.
Let's jump into a few of them if you don't mind.
Yeah, but there's a concern I wanted to say with Melton about supply of vacant land and stuff like that. But that's in other suburbs. As you see, we've restricted the building approval ratio, so sort of we're safe there. You want to do Golden Square?
Yeah, show me.
Let's do Kurrajong.
Again, if you after access to Matt's platform, we're going to put a link in the show notes, so definitely click through and have a look at that. And if you want the long list of all these suburbs, so you don't have to write it in your phone notes, I will, when I post this episode, I'll send out that email to everyone and have options where you can comment and get all that stuff all for free, or because Matt likes providing people with the best data and knowledge possible.
Thanks, mate. So Golden Square is in Greater Bendigo. Industry centralisation is not, or diversification is sitting at 68 out of 100. It's not perfect. I mean, looking at the typical value, you can see how this one is much more essentially straight than the Cairns areas that we did in the last episode. And there was a bit of a pump and then a plateau, which we all know that Melbourne hasn't been doing well in the last couple of years, which provides great value for money, I would say. If we go down, look at Melbourne. there's actually never gone below zero. Only now potentially it will at the end of 2024. I mean, again, we are looking at growth rate cycle. It's been sort of flat between 2009 2019, and then he had a pump. It went down, but it's never gone below zero. And by the way, this is not a perfect graph. I mean, again, as I said, whether GS growth rate cycle is good or not depends on how the other areas within the same state are behaving under the same price point, and you'll see it's not perfection, but again, we're investing under 550. You know what I mean? The good thing about it is that it's never gone below zero. So it means something is pulling it up. ERSAT of 3, rent to owner ratio at 35, not ideal, but right on the threshold of my research and what I usually do. I set it at 35 or less.
Do you have a red flag number?
Yeah, we do. It's in our data dictionary. I can't remember now. I think if you go to 40, it's already red flag. 30.
Okay. Yeah, thought it'd be about
that. It's very affordable. It's sitting at 30 years to own.
Perfect.
3-bedroom dwellings are most in demand. So if you go out and buy, again, go where the demand is. It helps a lot of buyers agents, for example. They're going to a particular suburb. They don't know which, house to buy. Well, buy the one that's most in demand. It's 3-bedroom. Don't go for 4.
Oh, by 300-400%. I can see by that graph. Yep.
Correct. Yeah. And then see, this is. I mean, if you're ranking the suburbs, this one is not going to be on top simply because its stock on market is dropping. Overall trend, recent trend is maybe on trend. But the issue that I have with this one is that, for example, it's 3-month rolling average days on market sitting at 50, which is fairly high. Okay, that allows you to negotiate the price down. However, I'm concerned about its overall trend and the slope of the overall trend. It's actually trending up rather forcefully. So in order for this trend up to actually shift onto a flat trend and then allow for the owner occupiers to actually stimulate or kickstart the growth cycle, it will take a fair bit of time. So we're not potentially looking at 2 years, we're potentially looking at 4. Now, if you're, again, it all comes down to timeframes. An area is not just shit within itself, you know what I mean? If you're fine sitting on the sidelines for 4 years, maybe, you know what I mean? And also, by the way, you might come in and actually negotiate a property down substantially. So you might make money. Let's say you negotiate it down by, I had instances where people buying in Melton West negotiated 550K property down 80K. That's a substantial percentage. So they can sit on the sidelines for 2 or 3 or 4 years, Yep. Inventory is also dropping overall. Short-term trend is, but slightly, it's still dropping. So supply is reducing. So look at its hold periods are sitting at 9. It's right on trend. So it ticks all of the boxes. I mean, I would like to see a vacancy rate that drops, a slope that drops, because that sort of tells me that sooner or later the rental demand will shift to days on market demand. In this instance, it's not happening. So a few concerns. It's not the best, but let's see how that behaves in comparison to others, I guess. Yep. Kurrajong has better industry diversification.
Big population, 10,000 plus.
Correct. Typical price curve trending up with a few bumps, but much more forcefully up than Golden Square. Growth rate cycle. See how this growth rate cycle is much more pronounced. It's much more cyclical, which is always better than when you look at Golden Square. Look at Golden Square. This is not a cycle. This is like...
Yeah, so for people that are listening to this, the growth rate cycle of the suburb of Golden Square, it kind of looks pretty flat with a few minor peaks and troughs around 1% up and 1% down. Pretty flat, and then obviously had the massive spike around COVID in 2021, 2022. However, when we go back
to Kurrajong, you can see cyclical behaviour.
Yeah, okay, so massive spike in 2019. What's that, 20% plus?
20... this one is 20% plus, and then we got another spike.
So 25, dip in 2012, back up in 19, 20, then another dip, another peak in 2022.
2022, that peak was, 14%? So essentially, an area that behaves reasonable. This is reasonable behavior for an area. And I can say that this area has market fundamentals that push the price up and down because everything moves in cycle. The only constant is the fact that everything is changing all the time. So with Golden Square, though, we can't say that its growth is because of market fundamentals. We saw the printer going berserk during COVID. So who knows why this is so? You know what I mean?
Yep.
So a downgrade for Golden Square with this respect. Earthstat is sitting at 2, which is okay for this price point. It's not ideal, but it's okay for this price point.
Yep.
It's to be expected, essentially. Affordability index is sitting at 30, which is okay.
Very affordable. Demand there for 3 and 4 beds.
3 and 4 beds. I mean, if you buy both, you're doing okay because they're in demand. 3 bedrooms are more in demand. And let's look at
lower renter to owner ratio. It's only at 24% here.
Correct, yeah.
Great.
24%. And now let's look at the supply and demand. See, this is a perfect, I would say, warm spot. We have an overall trend reducing in stock on market. Recent trend is on trend, but it's trending down. We have the same with inventory. Building approvals are trending down. In actuality, there's no building approvals in 3-month rolling average, so it's 0.
Great.
And this is very important note for those who say that Melton is going to be overdeveloped in the future. Well, we know that 2 years into the future, because building approvals are 0 now, 2 years into the future, there's not going to be any from this point on, yeah? So, again, a caveat and a question mark about, but I'm not going to go into, land and how that it's just fear-mongering in my view. 8.5 years hold periods. Not dramatic change in sentiment as we did see before about the actual area and its appeal for its residents. Now, look at this, David. So we have a 33 days, which is opportunistic. It's sort of on the lower side.
Yeah.
3-month rolling average. The overall trend is sort of slightly trending up, but the recent trend, you can see that it's dropping. Well, if you count them, 1, 2, 3, 4, 5, 6, 7 below trend. 1, 2, 3, 4, 5 above trend. Yeah? And it's sitting at 33 days. So good signs. Let's look at the vacancy rate, taking a nosedive. That's a perfect warm spot there. So we see that demand is a little bit increasing. We see the demand for rentals is actually increasing dramatically. Rents will have grown definitely more in the last year. We see more than house prices. This is going to come to a point where ownership becomes more sensible than renting, and demand from rental demand is going to shift towards ownership, especially when we see now interest rates also improving as well. So I like what I'm seeing. This is a perfect warm spot.
Yep.
This is why I'm saying Cairns areas don't actually have those dynamics, because in Cairns we see already transition between warm and hot. So if I had to rank these two, just by looking at the metrics,
let's put a third one in the mix, just to out of this whole list. So we've already looked. We're adding Melton.
So we had looked at Kurrajong, which is in Melton, LGA. Let's look at South Albans Park, which is in Greater Geelong. So we had Bendigo, we had Melton, and then Greater Geelong. So
good spread.
Yeah. So what do we have here? And by the way, I see some BAs putting people in St Albans Park. So when I say putting people, it's not a negative. So the industry diversification index sitting at 70 out of 100. It's not ideal, but it's not too bad. Typical price curve, we see a substantial drop off in the last couple of years. So you can either look at that as a negative or as more value. By the way, volume of sales behind hasn't changed much. So I don't look at that as a negative. I think there's value there now in the market. We see that in the last 3 years, this area has been really, really losing steam a lot.
Wow.
So its affordability has definitely improved for its residents. We can look at it that way. The growth rate cycle, again, it's sort of wiggly. I mean, Kurrajong had a much better growth rate cycle. This one resembles more of Golden Square, but I would say that it had bigger pumps before than Golden Square. Golden Square was really flat from 2009 to 2019. This one had a few peaks. However, this one has gone more into the negative growth zone between 2023 and 4. Yeah, so this St Albans Park is actually going to see more negative growth in 2003 and 4 as opposed to Golden Square. But overall, I see a little bit better, but not as good as Kurrajong, I would say. But now let's look at supply. Let's look at so Ursat is sitting at 2, same as Kurrajong. 23 rent to owner ratio. I think it's close to Kurrajong as well. Kurrajong had 24. Golden Square had 35. Yeah. So, and then let's look at the affordability index. See, this one is, see how the affordability index actually pumped up and then it went down, as in like it started becoming more affordable.
Mm-hmm.
Well, this is because we saw this nosedive in the actual price.
Yep.
So essentially more value for money now in the market, which again, negatives can impact, price drops can impact perception in a positive way, in a sense that people feel now, at least it's owner-occupier residents, that it's more affordable to buy homes there, which could, let's say, if the supply is reducing, it could kickstart, owner-occupier demand, which incites price growth. Stock on market is slightly going down. Recent trend is also semi-low. But look at stock on market current 3-month rolling average is 0.18% for listings.
Not a lot.
In 3-month rolling average. You know what I mean? Like, that's tight. However, days on market is sitting at 42 days, 3-month rolling average, and overall trend is increasing and recent trend is increasing dramatically compared to the past. So now, is this a warm spot? I wouldn't say. In the same way, Golden Square is not a warm spot in a sense that it's more like, it's more cold than warm.
Get you, yeah.
This one is also, I would say, more cold. I get that the supply is reducing. It's fine. But on the demand side, we have, recent days on market increasing, dramatically, as well as vacancy rate increasing. So if I really want to talk warm spot, I would say that Kurrajong really, really fits the bill. And if we go back, you can really see that, from supply side, on the demand side, 3-month rolling average sitting at 3 to 33 days, while vacancy rate taking a substantial nosedive.
Yep.
So that's for the lower end. You happy with that?
Yeah, cool. All right, well, let's bump up the price a little bit, because obviously there's only so many options that you have when it's at that below 550. So now we're going to increase from 550 up until 800. Generally is our second bracket. Investors with a little bit more money to play with. We're going to keep the same filters. That leads us to 17 different suburbs. Again, listening along at home, you don't have to remember all 17. If you have a look at your screen, you don't have to remember all 17. We're going to put together a list for you, and you can just download it for free to get all these suburbs, so you can have a look individually.
Some of the suburbs from the previous price point sort of came in, essentially. Both Kurrajong and Melton West are there simply because we enable the bedroom filter. If we disable the bedroom filter and we go to just all, what do we have? We have Stratdale, Derrimut,
not many.
Yeah, not Derrimut, but not much. But I'll enable the bedroom filter because there's one in particular that I like.
Yeah.
So.
Oh, where did it? Did that change that list? No. Oh, yeah. Okay.
Yeah.
Yeah.
So Hillside, from memory, I think Hillside is also Melton LGA. Yeah, this one is pretty good.
Mm-hmm.
Now we haven't looked at that one. Strathdale, we haven't looked at that one. Derrimut.
Scroll over so you can see the LGA suburb, the LGA areas.
Who, me?
Yeah.
What do you mean? Oh, here?
No, on that bar, go back. On the bar down the bottom, scroll across because it shows in the data.
Yeah, sorry. Yeah. You mean
I'll teach you a thing or two about it.
Yeah, sorry about that. Yeah, so we got Melbourne, Greater Melbourne. You got Bendigo, Melbourne West.
Yep. Okay, let's have a look at a couple of these again. I
particularly like Hillside.
Mm-hmm.
This one is really interesting. and you will see from the data that it's, you got industry diversification.
Huge population, 17K plus.
Yeah, look at the typical price, how smooth this is. And see, it hasn't had a lull as the other ones. If you had a have a look at that. It has seen, the other ones have seen negative growth. This one has actually been growing close to 3%, now 2.5.
Yep.
So it hasn't lost steam as much as the ones we had a look before. You saw, the pump down. As well as the line, it's nearly perfect. If we look at the growth rate cycle, it is went into the negative growth zone twice, but only, slightly. This is minus 2.3%. The next time was minus, 1%. URSAT is sitting at 7.
Wow.
Rent-to-owner ratio is 15. Okay. And the affordability index is still below 35 years to own.
Wow.
So now, what I forgot to do here, I should have, because I've enabled to 800, I should have went to affordability index 40 years to own, and then the database then you get the Curran Downs and all the other. Curran Downs is actually a good area.
Yep. We'll jump into that one next.
Yeah.
Yeah.
Taylor Hills is my favourite, Australia-wide.
Wow.
Yeah.
Okay, let's finish this and jump into Taylor Hill.
Taylor Hills is actually next door to Hillside. So they're very similar. See, Taylor, where is it? I think it's next to, Taylor Hills, see? Taylor Hills is here. Hillside is there. But Taylor Hills has Taylor Hills has nearly perfect metrics.
Wow.
Yeah, nearly perfect. I mean, it's very rare, but you can come across it. Yeah.
Everyone on YouTube is just copying me, looking at them like, you're welcome.
Yeah.
Right, let's have a look at this so we know what.
So what do we see here? Quickly, we see a dropping in stock on market, overall trend. Recent trend would be on the trend. Inventory is dropping overall. Building approvals, there's none in the last couple of months.
Wow, good sign.
Yeah, look at 13 years to own.
And not too many people on that whole period. A lot of them, there's still big peaks and troughs as that climbs up. But this one's like, it's flattening out a little bit.
Yeah, it's fairly straight. There's no change in sentiment. And by the way, sitting at 13 years hold periods now.
Wow.
How you saw the other ones? How?
Yeah,
so people
7, it's almost double.
Look at the days on market. It's actually flat, perfect flat. Recent trend, maybe a little bit below, but 3-month rolling average is sitting at 26 days. That's like a hot market. You know what I mean?
Yeah.
Vacancy rate, boom, look at that. Nosedive.
Okay.
So that's a warm spot. This is
Ooh. We just lost lights in the studio.
Yeah. So this is like a hotspot in disguise. Nobody know, and this is why it's dominated by owner occupiers. I know, for example, in Taylor Hills, the intel from on the ground is that there's 10 owner ocs and sometimes 15 competing for the same house already. Wow. It will be the same hillside, and if you look at Taylor Hills, for example, let me just cancel these ones because. So if you look at Taylor Hills, let's open it up. Look at this baby.
All right.
Now check. Just so there's many reasons why I like this area. I want to show you the first one. Look at the disparity between 3 and 4 bedroom homes.
Okay, so
724 is a 3-bedder, 989 is a 4-bedder. So imagine you find a house with a carport, and you add a bedroom, external bedroom. Yeah, you're reading
720
that. You're reading that right.
Wow.
So not only are you, let's say, if you can find, by the way, the fact that this is the case doesn't mean that you'll be able to find it, but there's huge opportunities there. You can make 200K off the bat by adding an external bedroom. Let's say you allow 50 to do it.
Far out.
So there's huge potential for value add. Okay, so let's just go down then. Industry diversification index is phenomenal, 15,000 population. Look at this typical price curve, my friend.
Yep. Sorry. Go.
Look at this typical price. Look how straight this nearly is. Nearly no lull, no drop. This is perfection there. Look how evenly distributed that is. Growth rate cycle went into the negative growth zone once, minus 0.5%. Look at these cycles. Perfect, URSAT of 8, 9 rented to owner ratio.
9%.
Yeah.
Wow, that's phenomenal.
Affordability index is sitting at 35. However, look at the price point. The price, 857 typical value, and it's still sitting at 35. So that's very affordable for its residents. Look at the stock on market. Much forceful nosedive than for Hillside.
Mm-hmm.
Look at the days on market. 25 days rolling average. It's flat, but look at the 25 days 3-month rolling average.
Wow.
Inventory going down. Building approvals, none in the last 2 months. Hold periods. Look at it. Look how straight that is. A bit of change in sentiment sitting at 10. That's nearly perfect. Vacancy rate, boom. Look at that, baby, coming down.
That's crazy.
Man, it's a great area. It's honestly, it's phenomenal.
Well, what's great is the search index has come off a bit, so there's not too many people looking at it.
That's right. I don't care.
Yeah, that's good.
We're looking at it now.
Yeah. Well, now
they start searching now.
Yeah, shit.
So
maybe we don't release this one. We keep it between you and me.
Mate, listen,
a couple of 3-bed conversions.
Mate, listen, I like a lot of people in the community have tried to they actually went just to check it out, because I've been talking about Taylor Hills for a while, and they went to check it out to see how many people are showing up to open homes. And I'm telling you, 10, 15 owner ox are fighting for the same house.
Wow.
That's why it's 25 days. Although the days on market is flat, you saw the flat trend. It hasn't moved, but it's 25 days. That's a hot market. And yet it's in Victoria, the ugly duckling Victoria that,
Allegedly.
I
mean, you look at the data doesn't lie. You can say what you want about Victoria, but this data is incredible.
Look at a little bit of a nosedive. Look at this steep nosedive here in the supply in the last 1, 2, 3, 4 releases. Man, that's great. This is 3 quarters, 4 quarters. Taking a nosedive. While the days on market, it's sitting at 25 days, 3-month rolling average. And it's affordable for its residents. I mean, I don't know what else to... And by the way, look, you buy a 3-bedder, 4-bedder is more in demand.
Wow.
So that's what... Perfection doesn't exist, but if you had to, call it would be this one. That's a good area, man.
Wow.
That's a great area. And you know how some of the buyer's agents, say, if you want to buy a good investment property, buy what an owner-occupier would buy.
Yep. There you go.
Yeah.
Okay, is there any others off the back of that, out of that, maybe one for this price range?
This one's pretty good as
Carrum
well.
Downs, yeah, let's have a look.
The only issue with this one is that it's URSA. So everything else is good. So Hillside and Taylor Hills had an URSA, a socioeconomics of 8. Now, as I said before, in order for an 800K typical value area to get to 1.23456 mil, it needs to have better socioeconomics, preferably higher than 3. Now, Carrum Downs, I apologise if I mispronounced this, has a 733K typical value. Everything is great, but I think you see industry diversified, larger town, no exposure to flooding or bushfire, only minor. Infrastructure spending is fairly large. This is nearly $1,000 per capita. That's huge. It's been pumping or growing constantly with, a small plateau, but not much. Growth rate cycle, again, cycles are pronounced. It's gone into negative growth zone a couple of times. 4% before in 2012. Then you have 4% in 2019.
Bottom of this cycle.
Yeah.
Okay. Good time to get in the market, huh?
No, that's right. I mean, see, the URSAT is 3. Again, not ideal, but again, you can't find perfection, Yep. Rent-to-owner ratio at 27. See this is what I'm saying why Taylor Hills is so great. And by the way, this is still a good area. But look, this affordability index is sitting at 36.7. And the price point is 733. Taylor Hills affordability index is sitting at 35, and it has a bigger price point by over 100K.
Wow.
So you see the power that's there in the market, because it's very affordable for its residents. So anyway, going back to Carrum Downs, overall, I mean, look, 20 days, 3-month rolling average days on market. And recent trend has been dropping. So it's heating up. Stock on market is actually reducing rather forcefully as well as recent trend. Inventory is the same. Building approvals, 0 in the last couple of months. Hold period sitting at 11. No change in sentiment, pumping up.
Yep.
Vacancy rate, reducing both recent and overall. So it ticks all the boxes. It ticks all the boxes. I mean, if you don't have above 800K to spend to get into Taylor Hills, this would be a great area as well. This one is below 8. It's 733. And I know some buyers agents are buying there, and I don't think they're making a wrong call.
Wow. Mate, that's perfect. That's a couple of good little areas. What about so this was 550 to 800. What about 800 plus? What do you got for us?
Let's do it. So greater than, we'll leave the same.
I'm still thinking about that suburb. That's crazy.
It's good. Mate, it's
very rare to see. Very rare to see.
So this one 800K. Mm-hmm. Let's see what we have. Taylor Hills again.
Of course, because we know that it had the 4-bedroom.
Yeah, that's right. We'll enable the 4-bedroom. So we got. I honestly haven't looked at these areas. So we got the hillside as well. So if I had to pick again, I'll pick Taylor Hills and hillside. But if you want to look at do you have any wish? Point Cook is good as well.
Yep. Let's pick a couple of these just to sort through. So this is if you've got 800 plus K to spend.
So Point Cook, let me just cancel this.
Yeah, tidy it all up there on the screen. Exiting those old tabs. Point Cook.
So which one would you like? Come on, it's your house. Pick one. I haven't actually analysed in this price point in a long time.
We'll give you guys the full list. Diamond Creek.
Diamond Creek.
Yep. And we'll go Newport.
All right, let's do it. All right, so Point Cook is the first one. 868 typical value. Let's see the disparity. Woof. Look at that, right? There's a bit of disparity there that you can take advantage of. So what do we see? We see a 3-bedroom house sitting at 671 typical value. 4-bedroom house sitting at 845. So let's say you can get 120K. Now, not allowing for LVR or anything like that, but if you allow 50K to add an external bedroom, you potentially could generate between 100 to 120K equity there. Bad at maths, but it's around that mark. Now, disparity between 4 and 5-bedroom is actually rather more substantial. Now, caveat there, 4-bedroom is 845K, 5-bedroom is 1,990,000. So that means you got 150
plus, yeah.
So 220K, 230K disparity, which is larger. Now, it does as I said, a caveat, go to the demand profile and see whether, 5-bedroom homes are actually in demand. Not really. Now, it is your at your discretion what you want to do, but there's a disparity there. If you can find a buyer, you're lucky and you'll make some money.
Well, there's a big difference, a big jump. If you go back to that demand table, there's a massive demand for 4 bedrooms. It's probably 4 times the size of 3 bedrooms.
Correct. So you can still take advantage there. No, I was just speaking about between 4 and 5. There's a bigger disparity, but it's still substantial disparity. Imagine this. It's a warm spot. You go in, you negotiate it a bit down.
Yep.
You add an external bedroom. You're looking at potentially 150K equity there.
Plus what you can, plus what the market does, plus what you can negotiate. So there's a good way to manufacture just in that area and in that strategy, 300K plus. And
it's a good food for thought for the listeners in a sense that there's not only one way to skin the cat, as they say. You can get equity and manufacture equity in many different ways. And why would you LB your way through a hotspot in a Cairns and Townsville and compete against other 30 buyers agents when you can do it in peace elsewhere?
That's very true. And as we said as well, there was those markets where you thought would be a good pump for a couple of years and then sell. But this is like a market that tells me that you're buying at the bottom of the cycle. You can manufacture equity easily with, getting in and spending 50 grand and adding a bedroom. You're adding 150 grand in your pocket, and then you ride, by the time you finish that, then you ride the whole growth cycle to the top.
Exactly.
Thank us later.
You can sit on the sidelines 3 or 4 years and not care.
Yeah.
You know what I mean? You're probably going to make more than, what an everyday investor going. By the way, when you enter a hotspot, you're overpaying for an asset anyway, and you're not entering at the beginning of it. You got to time it well. So you're actually putting yourself at a disadvantage. But coming back to this one, It looks good. Growth rate cycle. It's a bit of a belly here in a sense that between 2012 and 2015, it was growing negatively about, let's say -3, -3.5%. Then it didn't go under negative growth in the negative growth zone after that. I mean, its ERSAT is 9 out of 10, which is fairly good, while its affordability is 35 years to own. And see, this is what's interesting. So it's very affordable, has very good socioeconomics, and yet its price point is nearly, 870K typical value.
Wow.
So great combination. This is how we create this narrative where we see, okay, this area shows potential to sustain its price growth in years to come, because it has all the right ingredients. Rent to owner ratio is 32%, not ideal, but not bad. For this area, for example, the trend is slightly going down, the overall trend for stock on market. Recent trend, I would say, is a bit sporadic, but it's sitting at, 0.4%, which is great. What is interesting about this area, even though it's in Victoria, its overall trend for days on market is actually reducing. Recent trend, I would say, is maybe, if you look at a year back, it's right on trend. It's currently sitting at 44 days, 3-month rolling average. So it's not bad. Inventory is actually dropping. Building approvals. Okay, let's see that. So I don't think there's any building approvals in the last couple of months.
Perfect.
Overall trend is reducing, but before that, there was a bit of an uptick. So let's just see 3-month rolling average sitting at 0.05%, only 12 approvals. Whole period sitting at 8.22 years. So vacancy rate taking a nosedive substantially. So yeah, I mean, I would say this is, warm spot behavior. What are my concerns about this area? Well, Taylor Hills wins. This one I would like to see a bit of a more forceful downward trend in stock on market, but overall it's not too bad. And we, by the way, we're talking about Point Cook, yeah? Diamond Creek. Shine bright like a diamond. Let's do it. Okay, so 81 industry diversification index out of 100. Not too bad. It's in the green. Yay. Typical price going up. No plateau. It's actually seen a bit of an uptick recently. So there's been, watch, 1 million typical value, 1,100,000 nearly, 1.1. And it's seen nearly 5% growth in the last year. Talk about,
money for Jam.
Talk about Victoria not going up. Look at this: 3-bedroom and 4-bedroom disparity. What do you think about that? 300K, yeah.
300K between a 3 and 4 better. Let's have a look at the demand though. Show me the demand between 3 and 4 betters to see if there's any opportunity.
Oh, good.
Wow.
So 3 demand is in high. 3-bedroom house is in high demand. So is 4-bedroom.
There you go.
So, guys, there is opportunity there. Now, it is one thing, and I always want to say this. I don't want it to seem like I've discovered the wheel. There's one thing of looking at the data and finding a suburb that has a great disparity. By the way, this is coming in as a feature very soon, so you don't have to actually, you can just filter disparity. Because some of our buyers agents actually just do the value add, or investors as well. Now, coming back to what I wanted to say is that it is one thing to find an area that's great like this, but it's yet another thing to find a suitable home that will fit that. Let's say sometimes you can't add an external bedroom. You can add an internal bedroom as well, which is less money, and then you can, reevaluate the home. Bottom line is there's some work required for this to be done, but if you want to make money, you gotta do some work essentially. So, what I always suggest to people is find 3 or 4 areas that have a larger disparity and try to look for real estate in all. And then if you settle on one, you're on a winner. You know what I mean? The only thing about this one, for example, so it's sitting at 40 affordability index.
Bit high.
No, but it's $1 million typical value. That's great.
Wow.
So the affordability index shifts as the price point shifts. So the peak affordability index for any investment would be at 45. I wouldn't consider anything above.
Yep.
I would if the supply and demand dynamic are phenomenal, but 45 is there. So this one is sitting below the threshold. Let's look at the supply and demand. Stock on market trend is reducing. Recent is right on trend, I would say. Days on market, very similar to Taylor Hills in a sense that, yes, Taylor Hills is flat. This one, days on market overall trend is slightly increasing. I would say that recent trend is probably on the trend of decreasing, but 3-month rolling average is sitting at 22 days. That's phenomenal. So again, all the right ingredients. Again, a great opportunity here. Vacancy rate, I want to see it nosediving. Great. See, this is good about Victoria because we saw in Queensland that most of the vacancy rates are actually increasing. So not a bad opportunity here. I would say Point Cook, Diamond Creek, close. Close. Different price points. I think there's a difference of 200K there. But both have some great value add opportunities. And this is a general narrative in Victoria, the disparity between 3 and 4.
We didn't really see that in Queensland.
No.
Yeah. Okay, it's interesting how that works.
No, I didn't see it. So again, this is why, when people say something about a state, you got to read deeper and go deeper and understand, like, okay, what are the other opportunities where you can actually make money? So Cairns is pumping, Townsville is pumping, but is there opportunity to actually, for this disparity, to maximize equity? No, not as much as there is in...
I'd rather pay $1,000 in stamp duty to buy in this market if I know I can instantly make 200 grand by adding a bedroom.
Exactly.
Cost of doing business.
Exactly.
Yeah.
And then this one, Newport, 1.1. Let's see, what do you reckon about the disparity here?
Okay.
Oh, nah. Oh, well, look at the 3 and 4, and let's see the demand profile.
Okay, so just before you click to it, the 3 betters are about 1.1 million, 4 betters are 1.5 million. So you got 1.55. So you got about a 400 grand difference between 3 and 4 betters.
Now Newport is sort of, next to Port Melbourne. You might struggle. Maybe the land is smaller. You know what I mean?
Yeah, it might be harder to...
It might be harder to add an external bedroom, so you're restrained by the market. You know what I mean? But if you find it, you're on a definite winner there. You can retire after a couple. Let me just see the demand profile. 3 and 4 better. Okay.
There's probably half the demand there is for 4s as there is for 3s. So
yeah,
still,
that's why it's selling you smaller blocks. Affordability index, what is it? Woo! Look at that, man. It's sitting at 36.4, while the typical value is 1.2 mil.
Wow.
That's very affordable for its residents. Must be cashed up people living in there, Newport.
Same with Newport, New South Wales too, so...
Yeah, see?
Cashed up.
Like for like.
Interesting.
Same. Now, Ursat at 10, as expected. Renter to owner ratio is 29, which is okay. You know what? This is a good area, man.
This is a good little find, huh?
Yeah.
There you go.
Like, look at it. It's stock on market is reducing trend overall. Recent trend is on trend. Days on market is flat. Overall trend, recent, I would say, is on trend, but it's at 37 days, 3-month rolling average, which is not too bad. It's neutral, I would say. Inventory is dropping. Building approvals, nothing in the last couple of months. Let's see, 3-month rolling average, 0.32%, 12 approvals. Nothing dramatic. 10 years hold period. Let's see the vacancy rate. I'm interested. Like Victoria.
Here we go. Hang on. Okay, so this isn't a bad little area, Newport Vic, huh?
Yeah,
for those with a bit of a bigger price range.
For a bit of a bigger budget, definitely not. The market dynamics are there. Rents have been pumping, $730 per week. Yield is pretty high considering the price point, man. When you really think about it, it's above 3%.
Yeah, it's not too bad. If you're buying in at 1.2 million, you got to expect that the yield's not going to be anywhere near 5.
Yeah, but think about it this way: encouraging yield is 4.5 or 4.
True.
Do you know what I mean? So that's what I'm trying to say. This is encouraging. Has got 500K typical value. Yeah. So it's not bad actually. So yeah, those I would say not bad little picks.
Yeah. All right. Well, look, Matt, I think we've covered enough value for our audience in this one in all 3 different price ranges. There's a couple of little areas that I think everyone's going to run absolutely straight to looking at this data. It's been incredible, but appreciate your time and your insight. Any closing thoughts on Victoria and what we've sort of seen and discussed today?
Not. I mean, closing thoughts are, there is obviously you can see that the market is shifting, supply is reducing, days on market, 3-month rolling averages for some of these areas are reflecting essentially a hotspot. I mean, it's not a hotspot. I want people to get hooked on that word, but when it's around 25 days, 3-month rolling average for days on market, that's pretty good. And there's a lot of value there or a lot of opportunity there for value add, which we don't see in Cairns, for example, in Queensland areas. So I'm happy that investors are definitely gonna soon or even now have more opportunity just flocking to those main areas in Queensland. There's a lot of opportunity there and variety.
Yeah, I'd probably close with as well. A lot of people are turned off because of government charges, land tax, that kind of thing. But I think when you look at that in the scale of that only going to be like $1,000 bill a year compared to what we've looked at today and the opportunity to, get in the start of growth cycles that everything else lines up, all the other metrics look really good, and that disparity between the bedrooms as well, huge opportunity. So if you are willing and you have that budget, I'd definitely be looking into these areas, and I wouldn't let a little land tax bill of $1,000, $1,200 or something a year eliminate this from your selection criteria or your potential investing area.
As you said, cost of business. Absolutely.
Cost of doing business. All right. Well, Matt, look, I appreciate you coming on the Everything Property Podcast, my friend. Until next time, maybe we'll do a New South Wales one.
No problem, mate. Anytime. I love coming here. Thank you for inviting me, mate.
All good, man. Thank you so much for coming on. I appreciate it.
Cheers.